Once again, memory stocks fell this morning by about 10% during trading hours in the Korean stock exchange. In pre-market trading in the United States, memory stocks like SanDisk, Micron and SK Hynix are down by another 10%. All while analysts, commentators and news reporters continue to show the unbelievable demand markets keep selling off on. So that's why in this video I'm going to walk you through why this sell-off has happened, what I think needs to be considered going on into the future, and where we will go from here. So let's just begin, shall we? So as I said, the Korean composite stock index has been falling and it's not looking very good. Just by looking at this chart alone, we can see that the Korean composite index has fallen by about 9% on the day. But that's not just it. And SK Hynix has fallen by about 15% overnight. And that follows the news that on Friday, the stock, as it hit the American depository shares, actually rose by about 15%. So it was quite a remarkable day. We had a 15% climb on Friday and now a 15% fall on the Monday. But why is that? And we can even see that it's actually trading down 6.11% on the Nasdaq following what happened in Korea. What investors must remember is that because of all this supply and new shares have had to hit the market because it was an equity offering, that shocking supply has met the profit taking from SK Hynix shareholders all at once and has caused a de facto sell-off. But that's not the only reason. Investors must realize that at the moment, after a parabolic run, trades like this are going to have shakeouts regularly and it's going to be choppy for a while because investors who are sitting on large amounts of profits are going to eventually just find themselves unwilling to hold on to those much longer and begin to sell. And that's what we're seeing. It doesn't mean the trade has ended. It just means people are at their end of their run. But there's also other news we need to talk about. So Dukan, a pretty well-established figure on X when it comes to the memory trade, released internal notes from the KIS Semicon analysis, which says that for the second quarter of SK Hynix's results, which come out in a couple of weeks, their actual second quarter 26 results, operating profits, will be about 60.4 trillion won, which is down by 8% from consensus estimates of 65 trillion. Now, on the face of it, that looks absolutely awful. Operating profits coming down when margins are expanding and prices are getting higher. How can that be? Well, actually, if you read the whole article, you'll hear, which I think is going to become more common, that many of these memory players are beginning to sign long-term agreements. And those long-term agreements do two things. One, they create certainty of long-term revenue and profitability for the years to come, but at the cost of one thing, and that thing is margins now. So you give away a little bit of margin for longer term profitability and smooth revenue and profitability in the future. Now, depending on the type of investor you are, you may like that, you may not like that. Clearly, the markets don't like that type of behavior because you're basically giving away profitability now and just getting it back in the future. And people will say, why do that? I don't think it's as clear as that, but that's what's happening. But we also have good news that's happened over the weekend that I think the market's not really considering. But before we get into that, I'd really appreciate if you could either like this video and if you're not already, subscribe, because it really helps push this channel and this content to new people. I've also found out that recently, if you press the hype button, that pushes the video even further. So if you can press that button, I'd really appreciate it. And consider joining the community. I'm trying to build something here where we track the sort of memory trade and AI trade all together. So I'd love to have you. Anyway, let's get back to the video. So do you remember only a couple of weeks ago when the whole market sold off because they feared that Meta was about to reduce its capex because they were willing to sell excess capacity at a ridiculously high price? Well, it turns out that that was a load of crap, as we've reported on over the last couple of videos. But what has been released recently is that in actual fact, Meta's Louisiana data center, the big data center that they're currently building, their investment is going to reach $50 billion. So that's up from, as we can see in these key points, up from just $27 billion that was released in October. So within, 9-10 months, the figure has almost doubled from their original estimate, which just goes to show that when we get the capex guidance from the hyperscalers like Meta in only a couple of weeks, we should begin to expect that projections are going to increase, because at this current rate, they're going to spend a lot of money. If we actually look at that article we were just talking about, it does go on to say that the actual investment in the Louisiana site in total, I don't think it's this article, I think it is this one, is actually going to cost about $250 billion once you account for all the chips. So it's an enormous amount of spending over the coming years. So that means capex surely isn't going to guide lower. And that's a really important catalyst for the future. We also know that Meta recently agreed a long-term multi-year agreement with SanDisk to increase their AI infrastructure investment for those facilities like Louisiana. And that's important for a number of reasons. One, because it's another showcase that capex spending is not going to guide lower anytime soon, and it's one of the most important catalysts we can wait for that's going to come out in this month. But also, it just shows that the memory trade has no end in sight. Even SanDisk, which is selling NAND, which obviously in the long term is considered less important than DRAM, which is used for inference, even SanDisk has multiples to go. And as a result of just that article and some of the sort of key developments we've seen over the last couple of weeks, we're seeing Evercore increase their price target for SanDisk quite considerably. Evercore have changed their price target for SanDisk from $1,400 a share now to $3,100 a share, an enormous increase, all thanks to what we are seeing right in front of us, which is just incredible demand for memory going forwards. Their report, just in the first paragraph, says all you need to know. We're raising our revenue earnings per share estimates on SanDisk along with our target price of $3,100 as we think investors are underappreciating the durability of SanDisk's earning per share and free cash flow over the next few years, and further pricing power as the supply-demand imbalance persists through full year 26 and 27. Which is exactly what I think too. I just don't believe people quite understand the amount of revenue, amount of profit, the amount of earnings per share these companies are going to generate, and what they'll be able to do with it in the future. And what you've got to remember is that as of today, because of the most recent sell-off, if you do believe analyst estimates, which I'll get to in a second, SanDisk is actually priced at $1,700 a share, well, $1,739. That's an enormous amount of upside. Well, while I'm cautious, if not pretty much anti-investment banking analysts' price targets simply because of their perverse incentives when it comes to selling stocks, it does directionally align with what most companies' expectations are of the future, and it's what we're seeing in the data. For instance, Bank of America Global Research just released this global memory forecast report, and it's quite bullish for the memory trade. If we just look here, we can see that they're provided revenue estimates and demand estimates for DRAM and NAND going into full calendar year 27. And as we can see just on the top line right here, we can see that for the full year 27, revenue for DRAM and NAND will be higher than it was in 2026, which is extremely bullish and is exactly what we expected, with it to be peaking at the fourth quarter 2027. It also aligns with what I'm expecting, which is that just generally speaking, revenue for DRAM and NAND will just be way higher each quarter that goes by. What it also tells us, which we should also expect, is that price increases are going to fall, but they're going to still rise, but just not as much as they were previously. As we already know, and as something we always have to be conscious of, is that you can kill demand with prices that are too high. So this just aligns with our own expectations. And finally, because I love reporting on these estimates, Morgan Stanley only recently reported their own 27-28 capex spending guidance, and they're expecting exactly what we think, which is 27 total capex from the hyperscalers reaching about $1.23 trillion. And obviously 2026 about $779 billion. An enormous increase, and that number to increase to about just shy of $1.4 trillion in 2028, simply because there's enormous abundance amount of demand for AI infrastructure. Now, investors do need to consider something that's quite important, and this story from the Wall Street Journal says exactly what I think we need to consider, which is that the $250 billion onslaught of AI bonds is testing investors' limits. The article goes on to say that Wall Street is sending a message to tech companies engaged in a historic borrowing spree to fund investments in artificial intelligence infrastructure. For pity's sake, please slow down. Over the past several weeks, the investment-grade corporate bond market has struggled to absorb the combined $75 billion of bond issuances from Nvidia, SpaceX, and Amazon.com. That marks a shift from earlier in the year when investors were generally happy to hand money to so-called AI hyperscalers, by any means possible. As we can see in this graph, hyperscaler global bond issuance has absolutely skyrocketed and will probably keep rocketing as we go on into this decade. We can also see here that the yield premium for corporate bonds over the treasury is actually rising for all of the major Mag 7 companies like Meta, Amazon and Alphabet, almost surpassing the investment grade average, which just means that there's just becoming a lack of appetite for this kind of debt. Why is that? Simply because investors, at least bondholders, believe that as soon as they issue more debt, Amazon and the likes of Meta will just go out in a couple of months, 6 months, 12 months time and issue even more debt. So they want a higher yield as a result. Or what we'll see eventually as the money dries up is that they're actually going to go through equity issuances and dilute current shareholders to raise more money because the world is going to dry up and they need to access capital somehow. Now the issue here is that growing this quickly, this fast, there is only so much capital that is available to you to grow. And that means just one thing. There could become a limiting factor in this story, which is that there's just not enough money to build this quickly. Ultimately, though, what I want to say is that the build-out is ongoing and the demand for AI is there. You can see it. You can see the prices are going up. Capex looks like it's going to be revised upwards. And the doomers who don't believe AI has any value, like for the likes of people online, I genuinely believe a lot of them probably haven't used AI properly since 2023 and still anchoring on the product that they first interacted with on the early stages of these models' development. Because when you use it day to day, there's real value to be gained. It's changing some people's lives. It's an amazing tool that people can use to increase their own productivity. And to make it clear, I am an investor in Micron and SanDisk. I'm not an investor in SK Hynix. And I do believe in the long run, these companies be profitable. But the other thing investors must be aware of is that there does come a point where this trade ends. And there is a price where we have reached a fantastic price to get out of the stock. We're not there yet, and I don't know what that price might be because there's so many variables at play. But you need to be aware of it, that eventually the market will offer you a price for your stocks that's fair, and you need to get out. I'm saying that because some people are expecting the likes of Micron to be $10 trillion stocks. It won't be. It may be a $3 trillion stock,